The U.S. markets are currently closed for pre-market trading. As of the final bell of the last trading session, Tesla Inc., Nasdaq ticker TSLA, closed at a staggering $458.96 USD, marking a significant single-day surge of plus $12.09, or 2.71%. This price action places the company firmly back in the trillion-dollar club, specifically a market capitalization hovering around $1.46 trillion, reigniting the fervor that many bears thought had been extinguished permanently during the darker days of 2024. If you are just tuning into the Tesla stock narrative, you might expect this price jump to be driven by a sudden spike in vehicle sales, or perhaps a new tax credit announcement. That is the expectation, that Tesla is a car company, and its stock moves when it sells more cars. The reality, however, is fundamentally shifting beneath our feet. We are witnessing a complete decoupling of Tesla's valuation from its automotive fundamentals. The insight that you need to grasp right now, the one that explains why we are pushing toward $460 despite soft delivery projections, is that Wall Street has effectively stopped caring about how many Model Ys roll off the line in Shanghai or Berlin. The market is no longer pricing Tesla as an automaker. It is pricing it as a sovereign AI entity. The tension here is palpable. Traditional value investors using platforms like Schwab Intelligent Portfolios are looking at a price-to-earnings ratio north of 300 and screaming bubble, while growth investors are looking at the Optimus bot and FSD, full self-driving progress, and screaming cheap. This script is going to dismantle that tension and show you exactly why the smart money is positioning itself for a breakout that has nothing to do with wheels and everything to do with neural networks. Let's look closer at the recent market movement. That 2.71% move wasn't just a random fluctuation, it was a technical breakout. For weeks, Tesla stock has been consolidating, coiling like a spring around the $430 and $440 levels. Traders on the Robinhood app and active users of Interactive Brokers trading platforms have been watching the $450 resistance level with bated breath. Crossing it and closing convincingly above it is a massive psychological signal. It tells us that the bulls are in total control and that the bag holders from the 2021 highs are finally being relieved or have already capitulated. Volume has been robust, indicating that this isn't just retail enthusiasm, it is institutional accumulation. We've seen reports of major funds like Nomura Asset Management increasing their stakes, and when you see heavy hitters adding millions of shares, it's rarely for a quick flip. They are positioning for a multi-year horizon. But why now? Why is the stock surging when we know that the global EV market is facing headwinds, with competition from BYD in China and Legacy Auto in Europe? This brings us back to the expectation versus reality framework. The expectation is that reduced EV demand should crush the stock. The reality is that investors have moved the goalposts. A recent note from Barclays captured this perfectly, arguing that vehicle delivery numbers no longer move the stock. Think about how insane that sounds for a company that generates the vast majority of its revenue from selling hardware. But it's true. The market has decided to look past the valley of death in EV margins and peer directly into the future of autonomous transport and robotics. When you log into your Fidelity brokerage account or check your SoFi investing dashboard, you aren't buying a car manufacturer anymore. You're buying a call option on the solvability of real-world AI. This shift creates a dangerous but lucrative environment. If you are approaching this with a traditional investment mindset, looking at book value and cash flow multiples, Tesla looks radioactive. But if you view it through the lens of a tech monopoly in the making, the valuation begins to make a twisted kind of sense. The narrative is being fueled by the proximity of Elon Musk's other ventures, particularly SpaceX. With rumors swirling about a massive valuation for SpaceX, there's a halo effect bleeding over into Tesla. Investors believe that the shared DNA, shared material science, and shared AI talent between the companies act as a moat that no other automaker can cross. General Motors can build an electric truck. They cannot build a global satellite network that assists in autonomous navigation, nor do they have a sister company catching rockets with mechanical arms, proving that the same control theory can apply to humanoid robots. Speaking of robots, let's talk about Optimus. This is the wild card that bears constantly underestimate. The reality that is slowly dawning on the market is that the total addressable market for a functional humanoid robot is effectively infinite. It is labor itself. While this sounds like science fiction, the accelerated timeline of development, robots folding laundry, walking autonomously, performing factory tasks, is forcing capital allocators to assign a non-zero value to this business unit. Even if you assign a 10% probability of success to Optimus, the potential revenue impact is in the trillions. This is why you see Fidelity mutual funds and ETFs that track disruptive technology refusing to let go of their Tesla allocations despite the volatility. They know that missing the boat on the next iPhone moment of robotics is a career-ending mistake for a fund manager. However, we must ground this in the present. What is the company actually doing right now to justify a $458 price tag? Tesla is primarily an energy and automotive ecosystem. They manufacture electric vehicles, the Model S, 3, X, Y, and the Cybertruck, and they deploy massive amounts of energy storage through the Megapack. The energy business specifically is the unsung hero of the last few earnings reports. While automotive margins compressed due to price cuts, energy margins expanded. This provides a floor for the stock, a reliable cash flow engine that keeps the lights on while the AI division burns cash to solve self-driving. For those of you using online investing tools to analyze segments, pay close attention to the energy generation and storage line item. It is growing faster than the car business and has a clearer path to dominance as the grid modernizes. Let's pause for a second. I want to hear from you. Comment below how many shares of Tesla stock you currently hold, or if you are waiting for a dip to enter. Also, do you think the auto Robotaxi unveil will happen in 2026, or is it another 2 weeks away promise? Let me know in the comments. I read every single one. Now let's discuss the retail versus Wall Street dynamic. Tesla has always been the people's stock. It is the most held asset on Robinhood investments and a staple in Fidelity IRAs across the country. This creates a unique support structure. Unlike other stocks that might crash 20% on bad news because institutions flee, Tesla has a retail army that buys the dip religiously. This behavior acts as a dampener on volatility to the downside, while accelerating volatility to the upside. When you see Robinhood crypto traders rotating profits into TSLA or SoFi Invest users leveraging their accounts to buy calls, it creates a feedback loop. The gamma squeeze mechanism is always lurking with Tesla because the options market is so liquid and so active. If you are engaging in self-investing via an individual brokerage account, you need to be aware that you are swimming in a pool with massive whales and millions of piranhas. The price action is rarely rational in the short term. It's emotional and momentum-based. We also need to address the Schwab demographic, the retirees and conservative investors using Schwab Intelligent Portfolios or Fidelity Wealth Management. Is Tesla investable for them at $458? The conventional wisdom says no, it's too volatile, too expensive, too risky. But the contrarian take is that Tesla is becoming a must-own infrastructure play. If the world transitions to sustainable energy, Tesla is the utility, the gas station, and the car manufacturer all in one role. Excluding it from a portfolio might be riskier than including it, simply because you lose exposure to the biggest secular trend of the decade. This is the dilemma facing Fidelity ETF managers. They have to balance risk management with the fear of underperformance. Let's look at the risks, because if we don't, we aren't being honest. The reality of the expectation is that Tesla must solve FSD. The stock price of $458.96 demands it. If 5 years from now, Tesla is still selling cars with Level 2+ driver assistance and hasn't cracked true Level 4/5 autonomy, this stock could collapse by 50% or more. The valuation assumes a software-like margin profile in the future. If they remain a hardware company with hardware margins, the math simply does not work. You cannot justify a 300 PE ratio for bending metal. You can only justify it for selling bits and bytes. Furthermore, the key man risk with Elon Musk is at an all-time high. His involvement in politics, his management of X, formerly Twitter, and his split attention across SpaceX, Neuralink, and xAI creates a governance nightmare. Shareholders are effectively betting that Musk's chaos is the secret ingredient to his genius. It's a high-stakes wager.